Can a company genuinely report record-breaking revenue of $818 million while its flagship brand drops by nearly 12% and its net income literally gets chopped in half? Welcome back to Iron Financial. I'm your lead analyst, and my mission today is to help you forge a structurally stronger portfolio, cut through the relentless Wall Street noise, and evaluate whether recent corporate moves are built with solid iron or if they're just trying to sell you cheap rust. If you're serious about structurally sound investments, hit subscribe and smash that like button right now to fortify your strategy.
And I'm the market skeptic. I'm here to ask the hard questions for you. Today, we're doing a deep dive explainer on the Celsius Holdings Q2 2026 earnings report. And let me tell you, as someone who reads these balance sheets all day, there are some serious glaring anomalies in the structural integrity of this print. It's a paradox that has the entire market scratching its head, and we are going to break down exactly what's happening under the hood.
So we've got a headline number that looks absolutely fantastic on the surface, but we really have to ask the ultimate question here. Can a company legitimately report record revenue of nearly $818 million while its core flagship brand is actually shrinking and its net income is collapsing by 50%? I mean, are we looking at a company in a highly successful, albeit messy transition phase, or is the foundational structure genuinely starting to crack?
That is exactly the right question to anchor our analysis today. To the untrained eye, record revenue simply signals unchecked momentum. It looks great in a press release, but as structural investors, we operate on a very strict philosophy. We do not buy the headline. We buy the balance sheet, we buy the margins, and we buy the operational realities. We have to look past the top-line gloss to find out exactly where the real stress points are hiding in this business.
So let's strip away the corporate spin and look at the unvarnished reality of Q2 2026. On the top line, the revenue engine is absolutely roaring. We saw a 10.6% jump, bringing the total to a massive $817.9 million. But when you move down to the bottom line, the floor completely falls out. GAAP net income, which, remember, is the actual unadjusted profit remaining after all the bills are paid, plunged a staggering 45%. It dropped from just about $100 million a year ago to a mere $55.3 million today. Because of that, diluted earnings per share plummeted 58%, down to just 14 cents.
Right. And you rarely see top-line growth in the double digits paired with an absolute cave-in on profitability. It's totally disconnected. Total gross margins contracted. Adjusted EBITDA dropped 12% down to $184.2 million. Listen, when the top line goes up by tens of millions of dollars and the bottom line simultaneously falls through the floor, you know for a fact that there is severe structural friction inside the operational engine.
Now, the sheer scale of the top line is undeniable. $817.9 million is an incredibly massive quarter for a beverage company of this size. However, you really need to understand that this is no longer just the standalone Celsius brand show. This record revenue is entirely driven by their recent multi-brand portfolio expansion. Over the last couple of years, they've aggressively bolted on acquisitions to create what management is now referring to as a scaled modern energy portfolio.
Exactly. You've got Rockstar Energy contributing $66.5 million following its acquisition. But the real story here, the massive load-bearing pillar that literally kept this entire quarter from collapsing, is Alani Nu. Without these newly acquired revenues, that $818 million top line would be a complete mirage. Management loves calling it a modern energy portfolio, but to a pragmatist like me, it looks dangerously like they bought a shiny, expensive new engine just to hide the fact that the original one is stalling out.
We really need to force a direct comparison here to understand the true dynamics at play. We're basically looking at a tale of two entirely different operational realities living under the exact same corporate roof. On one side, you have the newly acquired Alani Nu brand experiencing absolute hypergrowth. It's flying off the shelves. On the other side, you have the flagship, core Celsius brand, the very foundation that built this entire company, in active, measurable contraction. The divergence is stark, and honestly, it is absolutely critical for anyone looking at this stock. The core brand is showing serious signs of rust, while the newly acquired brand is doing literally all of the heavy lifting for the entire enterprise. You simply cannot properly value this company right now without completely separating that acquired momentum from the organic decay. To figure out the true valuation, we have to isolate exactly how much weight Alani Nu is carrying. Let's talk about that weight. Alani Nu's retail sales exploded by 55.7% year over year. In Q2 alone, Alani Nu contributed a massive $364.4 million in sales.
This was largely driven by their aggressive transition into the PepsiCo distribution system. Getting plugged into that PepsiCo logistics machine is a game changer. It means instantly going from regional distribution to nationwide end cap dominance at every major retailer. Combined with massive consumer demand and highly successful limited-time offerings like that purple cotton candy flavor everyone is talking about, they actually surpassed $1 billion in retail sales just in the first half of the year.
It's an incredible growth metric for sure, and honestly a brilliant acquisition on paper. But it forces a really uncomfortable question. If Alani Nu is generating over $364 million and growing at nearly 56%, and Rockstar is adding another $66 million to the pile, what on earth is happening to the legacy Celsius business to drag the company's overall growth rate down to just 10.6%?
Well, the answer is that the core brand is rusting rapidly. Core Celsius net revenue actually fell 11.7% year over year. Retail sales at the actual cash register were also down 2%. The operational frictions on the legacy business are piling up, and they're starting to drag down the whole ship. Lead analyst management cites a few key structural issues causing these cracks. First, an aggressive SKU optimization, which essentially means they discontinued a bunch of underperforming flavor varieties to streamline production. But in the earnings call Q&A, they basically admitted they cut too deep and actually choked their own sales momentum. Second, we saw inventory rebalancing in the direct store delivery network. This means the trucks and warehouses delivering directly to retailers got totally backed up and had to work through excess product before buying more. Third, heavy trade investments. That means they had to pay retailers heavily in the form of discounts and rebates just to keep their prime shelf space. Now, the financial engineering meets harsh reality when we look at the margin erosion. Operating leverage went entirely in the wrong direction this quarter. Despite total sales growing by nearly 11%, the total gross profit barely crept up by 3.4%, hitting $393.7 million.
Right, and look at adjusted EBITDA, which is basically the cleanest measure we have of core operational cash profitability before all the accounting tricks. It actually compressed from 28.4% last year down to 22.5% this quarter. Think about that. When your revenue grows by $78 million in a single quarter, but your gross profit only manages to creep up by $12 million, your core operational efficiency is actively breaking down under the weight of your expansion. It's that simple.
Digging deeper, gross margin compressed 340 basis points, which translates to a full 3.4 percentage point drop, landing at 48.1%. As an investor, I have to question the long-term durability of these margins. Is this compression just a temporary glitch in the system, or is this the new painful normal for a multi-brand beverage conglomerate? Well, management attributes this severe compression to an arm wrestle with three primary pressure points. First, much higher promotional activity to defend market share. Second, an adverse channel mix as more volume shifts into the direct store delivery system. That system carries higher trade investments and billbacks, meaning retailers effectively charge the brand heavily for promotional space and placement. And third, severe commodity cost inflation, specifically in the aluminum used for their cans. Right now, the inflation and the promotional costs are definitively winning the arm wrestle. Lead analyst, beyond the margin squeeze, we absolutely have to drill into the massive one-off operating charges that completely destroyed the GAAP net income. Specifically, I'm talking about the massive $80.9 million charge taken in Q2.
Market skeptic, this right here is a textbook example of the hidden, painful costs of scaling through acquisition. That $80.9 million went entirely toward distributor termination fees associated with the Alani Nu integration. Basically, to plug Alani Nu into the massive PepsiCo system, they legally had to buy out the existing regional distributors and transfer the territory rights.
Exactly, and while management will always adjust this expense out of their non-GAAP figures to make the core earnings look cleaner and more predictable for Wall Street, it is a very real, very heavy cash expense that went straight out the door. It completely torpedoed the GAAP operating income, which fell 47%, down to $75.3 million. That's real money. Which brings us to the ultimate bottom line reality check. Q2 2025 diluted earnings per share was 33 cents. Fast forward a year with $78 million more in revenue, in Q2 2026 diluted EPS collapsed to just 14 cents. Even if we play nice and look at adjusted EPS, which strips out that $80 million distributor fee we just talked about, earnings still fell 23% to 36 cents. My question remains relentless here. Is this collapse just the messy middle of a complex integration, or is it a glaring warning sign of structural decay?
That is the central debate that will define the stock's trajectory over the next 12 months. If the margin compression from aluminum prices and promotional billbacks is permanent, then the decay is structural. But if this is truly just a temporary friction of combining three massive brands under one supply chain, then it's a speed bump that patient capital can ride out.
A lead analyst, management's defense of this messy quarter comes straight from CEO John Fieldly. He states they are building a scaled modern energy portfolio with distinct roles. They are deliberately forging a multi-brand engine designed to cover every demographic and achieve long-term category dominance. Celsius is positioned as the performance brand for the gym. Alani Nu brings in the younger demographic driven by bold flavors, and Rockstar taps into the gaming and action sports consumer. Market skeptic. Sure, the strategy makes perfect sense on a corporate whiteboard. But the reality in the grocery aisles is much more chaotic. I have to wonder if severe brand cannibalization is already happening. Are they actually acquiring net new customers, or are existing Celsius drinkers just switching to Alani Nu's new flavors because it's the shiny new can on the end cap? Executing a multi-brand integration without cannibalizing your core or blowing up your margins is incredibly difficult heavy lifting. To see if they actually have the financial strength to survive this heavy lifting, we always run a balance sheet check. This is where we look for absolute structural integrity. The cash and equivalents position remains remarkably strong at $631.2 million, which is up significantly from the end of last year. Furthermore, long-term debt remains relatively stable at $667.9 million.
I'll give them that. The immediate liquidity is undeniably intact. They have a massive cash cushion. They aren't going to face a sudden credit crunch tomorrow, which is a huge relief in a high interest rate macroeconomic environment. They clearly have the capital on hand to fund this transition phase. But as you know, a strong cash position today doesn't mean the foundation is completely spotless for tomorrow.
Like I said, the immediate liquidity is fine, but the rust is actively forming in the working capital. Unsold inventory has risen significantly, hitting $390.6 million. But far more concerningly, accrued promotional allowances have ballooned to an eye-watering $453 million. That's up heavily from $307 million at the end of last year.
That is a crucial red flag for future cash flow. Accrued promotional allowances essentially mean the company owes a massive mountain of future rebates, discounts, and billbacks to their retailers just to keep their products on the prime shelves. When you combine rising unsold inventory in the warehouses with skyrocketing promotional liabilities at the retail level, it paints a picture of a company having to aggressively buy its revenue growth. That puts immense pressure on future operational cash flows.
Despite those very real operational and cash flow pressures we just outlined, management aggressively executed on capital allocation, repurchasing $104 million in their own stock during the second quarter alone. This specific buyback brings their first half repurchases to over $124 million out of a recently authorized $300 million program.
And look, management will always tell you that massive stock buybacks reflect deep corporate confidence in long-term shareholder value. It's a great talking point for the press release for sure, but as investors, we have to be pragmatic and really scrutinize the timing of this capital deployment.
I relentlessly challenge this type of financial engineering. Do massive share buybacks make any logical sense right now? You have a core legacy brand shrinking by nearly 12%. You have gross margins compressing by 3.4 percentage points. You have an accrued promotional liability sitting at nearly $500 million. Is buying back stock the absolute best use of $100 million in cold hard cash? Or is it just an attempt to artificially prop up the EPS and the stock price while the operational foundation is under repair?
It's an entirely fair challenge. While buybacks absolutely signal confidence to the street, executing them during a period of intense margin compression and integration friction means they are intentionally removing their own shock absorbers. By spending that $100 million on stock, they are reducing their margin of error. If the macro environment tightens further, or if aluminum prices spike again next quarter, they might seriously wish they had kept that cash as a structural buffer.
So let's synthesize this entire deep dive into a clear trader's playbook. If you are evaluating the durability of Celsius holdings in the back half of the year, here is your rigid checklist. Number 1, core brand retail sales velocity. Management claims the painful SKU rationalization is finally behind them, and they expect a return to growth. We need proof in the scanner data. Number 2, the efficacy of Q4 cold space gains at major retailers. They are paying a premium for that space. Now it needs to yield real sales. Number 3, watch commodity costs closely. Any moderation in aluminum will provide massive upside relief to that compressed 48% gross margin. And number 4, the momentum of Alani Nu's limited time offerings, specifically the massive Q4 Witch's Brew launch, which is a make-or-break volume driver for the quarter. So, We arrive at the final verdict. You've seen the 11% top-line growth carried entirely by acquired momentum. You've seen the 45% drop in net income, the brutal margin squeeze, and the rising mountain of promotional liabilities. The question you must answer for your own portfolio is this: is Celsius Holdings a mispriced value opportunity temporarily weighed down by the heavy lifting of a brilliant multi-brand integration? Or is it a portfolio trap where shiny acquired revenue is successfully masking severe structural weakness in the core brand?
That is the analysis. We've stripped away the noise and laid out these structural realities. The numbers are the numbers, but the durability is up to you to decide. Keep your strategies structurally sound. Thanks for joining us for this explainer here on Iron Financial. We'll see you in the next analysis.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.